After finally finishing the big series, I'm very glad to be back doing market analysis, and I will be returning to my writing as well. So, let's check out where things are this week. In US equities, things had been looking pretty good for the month, but on Friday, yet another tariff panic showed back up, ending us down about 2.7 for the week. And this down move wiped out all of the gains for the month in the S&P, leaving us down 0.25. And this has just been a ridiculous roller coaster ride, where every single time there's a tariff announcement, there's total panic. Then it always turns out to be overblown, and then we go back to where we were. And this isn't to say don't pay attention to tariffs. They have very real significance. But at the same time, this whole year, markets have just not been rational, and this has given us a lot of opportunities. The Russell 2000 performed even worse, ending down about 4.17% for the week. And this is curious because the difference between the effect of this tariff announcement on the S&P and the Russell really shouldn't be so starkly tilted in this direction. So that's indicating to me that this was just a broad sell-it-all panic. Meanwhile, month over month, the Russell is down about 0.3%, putting it roughly in the same spot that the S&P is. And despite these stark moves at the end of the week, overall, this past month really hasn't been that eventful in equities. So let's check out the VIX. This is a large move. Over the past month, the VIX has been hanging out around 16, 17, but now it's got itself up, pushing 22. I'm certainly not freaking out about these announcements, and I haven't made any large changes in my equity exposure. But as I am an options seller, this to me looks like a time where we could be seeing some really good opportunities open up on the options premia end. I'm certainly going to keep watching and see where things end up, but I'm not making any big allocation changes right now. And I think that this is a really good moment of uncertainty with a significant volatility spike that could prove to be a really good time for traders and people in the options market. So I'm treating this tactically with no big strategic changes. We are seeing some really wild moves in silver that just will not stop. Up 3.33% for the week. Here I'm using the fund SLV as a proxy for silver, and I'm doing this because for most retail investors, these sorts of ETFs are going to be what most use to get silver exposure. Going out to a month, we have almost a 21% increase in silver. And when we look at the year to date, almost 69%. This, of course, has led to great excitement, and also a lot of people wondering if this is not sustainable. And I will be getting to a much more in-depth analysis of silver later in the video. But it appears to me that more than just investors rushing into silver speculatively, there are some really substantial and robust reasons why silver is structurally being bid up. And a couple of international markets that I want to highlight in the review. China. The MSCI China down around 7.4%. And it was fairly flat this week. Its big drop coincided with the tariff announcements. And going forward for this video, I just want to note the FTSE 100 index. The United Kingdom is in a really crazy spot right now, so I just want to highlight its year-to-date, up about 14.1%. The US 10-year yield dropped pretty significantly this week. At this point, we are very low in the fours, and could quite likely be seeing a 3 handle sometime soon. Year to date, the trend looks quite robust. And think back to earlier in the year when the story was constantly, the US is going bankrupt. Oh, look at how bad the debt is. No one believes in the US anymore. We're all doomed. Well, apparently the money disagrees with the doomers, as now that we sit here in October, it's been a pretty solid trend line down in Treasury yields. Sure, there have been some spikes and valleys, but overall, it's a pretty straight trend line down. The US Treasury is doing quite well. And just a couple of currencies to note, the British pound down about 0.6% against the dollar, and the euro down about 0.7 against the dollar for the week. First, we have the deployment of troops in American cities, and particularly what has been unfolding in Portland. This has predictably meant another fight in the courts. But for me, there are two things that are really interesting from a macro dimension about all of this. The first one is that by this point, we can really clearly see that there is a fundamental change in attitudes around law enforcement, policing, security. And while I have not made any new buys yet, I have begun looking into law enforcement, detention facility, military surveillance, and security equities. The second main point of significance about all of this is that on the larger societal dimension, and with respect to the current conflict between the different power factions of the West, it really looks quite evident to me that there is one sphere of factions that is interested in escalating chaos and conflict. As it's become more evident who is financing these riots, connections with organized crime have also become more evident. And when we go back to the larger picture of the financial network that exists offshore and connects intelligence, NGOs, organized crime, and financiers, and the factions that the administration is associated with, it looks quite clear that for the goals of the administration to be reached, there is going to have to be serious effort on the front of riots, crime, violence, and organized crime. So, to this end, I take this very seriously as a macro factor going forward, and not just thinking of it in terms of policing and troops versus violence and crime, but what it signals about where the factions are in their struggle for power. This shows that the nexus of activists, organized crime, NGOs, and financiers have reached a point of desperation where they are willing to let their assets burn, and that they're willing to let it escalate quite far. Meanwhile, the White House and the factions surrounding it have recognized that for them to achieve victory, they have to penetrate quite far into this nexus, and are going to have to use force. So this indicates where the momentum is, and that there is some serious pressure on the network at this point. So for these reasons, I am taking a much closer look at law enforcement, security, and stocks like that, and also expecting to see a lot of NGO contracts drying up and money leaving the offshore networks. Next we have the trade war, where this time it's finally it. We are finally all doomed and it's all going to collapse. The US-China relationship, I think, may be one of the most nuanced of American foreign relations. I'm not going to say that China is our friend nor ally, but I can't say that they're our enemy either. It seems to me like on the very big macro picture, both the Trump administration and Xi Jinping's China are actually both quite aligned, particularly with respect to wanting to end the post-war order as it had been instantiated. There are mutual interests between American sovereigntists and Chinese nationalists. However, for the Trump administration to get what it wants for the United States, that is going to by necessity hurt China. But I think there's a difference between this and an actual adversarial trade war. The Trump administration doesn't want the United States to be in the position where dollars are constantly flowing offshore, and where Chinese labor and goods constantly outcompete American ones on price. Additionally, there are also some other factors, particularly the fentanyl market. The administration wants these to end, or at least decrease. And by necessity, at least some of those are things which are going to be antithetical to the interests of the Chinese. But it seems to me that the two men have an understanding and have mutual respect. They're not enemies, and in fact see eye to eye on a great many things, while at the same time having other, different interests. I would go so far as to say there is some kind of détente between the United States and China, and even cooperation on some larger geopolitical interests, particularly when it comes to matters like the influence of the British and Europeans, the international monetary system, and how Europe and the United Kingdom have maintained influence over the pricing of commodities, gold in particular. So, just as before, I think that a lot of this is posture and theater. There are things that these two men, as strong leaders and almost mascot-like characters, have to do with their respective populations, and they each have to advocate for their economic interests which do not align. But at the end of the day, I think that the two administrations do want to have some sort of arrangement that is mutually beneficial, or at least acceptable. And that means that the worst scenarios that people are imagining are likely untrue. And not only is a lot of this posturing, but the two leaders actually have understanding with each other. So, going forward, while it may be rocky, I'm not really expecting much disastrous to happen. In fact, if anything, over the long run, we could be seeing better relations with China. I am most certainly not dumping my equities, and though it's a small allocation, I do continue to hold Chinese stocks.
Aye, what? You got a license for that license? Says here you're living in an house. Can't live in a house without a license.
Yeah, that's pretty much it. They're just a wreck. So, Prime Minister Keir Starmer has announced a free, mandatory digital ID. Those were his words. And immediately, both Nigel Farage and Robert Jenrick announced that when one of them, Nigel, becomes Prime Minister, the ID will go away. The entire country hates this, and it's almost certainly going to not exist in a couple years. So why would Prime Minister Starmer do this? Well, the conjecture is that fearing a leadership challenge, particularly one mounted by Andy Burnham, he needed to do something to gain political support. So why would he do the most unpopular thing possible? Well, this gave him the support of the Tony Blair Institute, which is one of the world's most powerful and far-reaching NGOs. A digital ID is something that Tony Blair has been trying to get done for years. Actually, since his own premiership. And so the reasoning goes, feeling squeezed in on all sides, he knew that he needed a very powerful ally, or someone to employ him once he's gone. He and Labour more broadly are in a very difficult spot. The chances of Labour winning a victory in the next general are quite slim. Increasingly, Labour MPs are beginning to say that Andy Burnham may be their only chance. And even then, it's a slim chance. So let's look at Andy Burnham for a moment. He's quite curious because he has very strong support in the north, particularly around Manchester and Liverpool. And while this could shore up and gain back some northern working class support, he's Northern, he speaks Northern, and he looks quite Northern. And while this may not seem like an enormous issue, there is still enormous anti-northern prejudice in the south. But putting this aside for a moment, why does this globalist NGO complex want digital IDs so much? And what are the digital IDs designed to do? They're free, mandatory digital IDs. And basically, you must have one on your phone, which is plugged into a very vast database, or else you cannot buy a house, you cannot work, and you can't pay rent. You can't live unless you have this ID on your phone. So immediately, pretty much everybody realized that this was horrifically dystopian on account of it is. This creates a digital panopticon and opens up all sorts of avenues for abuses by the government, and particularly considering that this is a government that is enthusiastic about jailing its dissidents. This is almost certainly going to be abused the moment it's rolled out, because you are the enemy! So there's certainly the stifling dissidents motivation, which is quite par for the course at this point, and this would align with the interests of Labour and the NGO complex. And considering that simultaneously the Bank of England has made more announcements on its digital pound project, which, yes, they want to be fully programmable and integrated with the digital ID so that the state has total control over all transactions, the ability to control when and where you spend money, and even the ability to simply take your funds from you. It looks as though the British state is gearing up to have total control over Britons. But the sheer enthusiasm right now, and the amount of interest that is coming from the Bank of England and from the NGOs, signals to me that this isn't just about Labour. And it's difficult to imagine that this is really just about squishing down dissidents either. There's really not much that they can do beyond the censoring that they're already doing. Perhaps they could ramp up arrests and crack some more skulls, but all this has really done is move sentiment even further against them. No, I suspect that this is about capital controls, particularly considering how interested the Bank of England has been in a digital pound and the timeline of its development. Think back to 2019 when it coincided with the development of the Going Direct plan. It seems to me that the financiers of the City of London, the NGOs, and the middle managers of Britain's globalist ruling class know that they're really out of moves and they're screwed. There has already been substantial capital flight observed in the United Kingdom. So if you had a large integrated state database, a digital ID, and a fully programmable digital pound, this would allow you the opportunity to do a number of things. One, it could force people to transact. And this is something that was raised by the Bank for International Settlements. The idea of expiration dates on money. But more than that, it could keep wealth trapped in. Say Westminster and the city began to really fear for the gilt. Perhaps rates are rising rapidly, and they know that things are only going to get worse. Well, they could do all sorts of things. Like, they could force people to buy gilts. Or, if they observed that people were trying to leave the United Kingdom with their wealth, they could simply say, no, and block all transactions which are attempting to move wealth out of the country. In light of just how hard they are moving on their digital prison, it seems to me that capital controls are only going to become more and more extreme. And I, for one, am exceedingly bearish on the British gilt. The City of London and the empty suits of Westminster know that it's just not going to last. This is a desperate play, and I do not expect it to work. Thus, my exposure to the United Kingdom is zero, and I am tactically looking for opportunities to open up short positions on their debt, particularly if banks with high gilt exposure start getting squeezed. What I have here is an Excel sheet that I created which tracks changes in sovereign debt spreads. So what's happening in the top table is it's taking the difference in the yields of the 10-year debt issues of different countries right now and at the beginning of the year, and it's keeping track of the changes. So say a country has a bond which right now is yielding 3%, and another country's is yielding 4%. If at the beginning of the year that first country's yield was 3.5 and the others was still 4, then the year-to-date sovereign spread change would be a change from a spread of 1 to a spread of 0.5. And in the bottom table, it is taking that change in spread and showing it as a percentage change. So pause the video if you're interested in looking at this, but I am going to move to a graph next. Here I have a graph showing the percentage changes when compared to the US Treasury. So if a bar is positive and going upward, that means relatively it is now performing better when compared to where it was at the beginning of the year when compared to the 10-year US Treasury. And if the bar is going downward, that means that relative to how it was performing with the US Treasury at the beginning of the year, it is now performing worse. So this doesn't compare their actual yields and which has a better yield, but the difference between the yields, has that moved in favor of that country or the US Treasury, and to what extent. And what we can see here is that most countries aren't doing that well when compared to the US Treasury. Now, keep in mind that these percentage changes are them compared to their relationship with the US Treasury at the beginning of the year, and not between each other. So something may have moved a larger amount in basis points than another, but its percentage will be smaller. This is really just comparing it to where it was and showing when compared to the old relationship how large the deviation is. And what we see is really poor performance from the United Kingdom. That's really quite noticeable. And that's a really big problem for the United Kingdom because, one, they're very debt dependent with a very large welfare state, an extremely burdensome pension system. And because their system runs so much on the credit creation of the Eurodollar system, meaning that they require US Treasuries as an underlying asset to rehypothecate, not only is a high gilt rate bad for the United Kingdom on its own terms, but having a high spread is particularly bad. Right now, it's blown way past where it was during the crisis of Liz Truss's premiership, and we see these worsening spreads really across Europe. However, and it isn't shown on this chart, but if you are to compare the sovereign spreads between European countries, something really quite interesting is that the change in spreads is favoring Mediterranean countries, particularly Italy and Spain, over Germany, the United Kingdom, and France. And particularly as this coincides with substantial political changes and a reordering of the broader economic environment, it looks quite clear that money is saying that it believes in the United States, and that Italy is now a safe haven asset, while Germany and the United Kingdom are not. The world is changing, and how money thinks about different countries is changing with it. The German Bund and the British gilt are no longer what they once were. I have a much larger market analysis report that I'm going to be putting on my Substack, but right here I'm just going to be giving a general overview of what's on it. So the general picture here is that I like US large and US growth. Generally, the macro environment for US equities is much better in my view. And with the larger monetary and financial backdrop, that I've talked about here and on other videos, I fully expect that money will be moving toward the US and not away from it. And while I very much like active management and do have a certain value philosophy, we just aren't in that environment yet. These factors and these flows that are moving toward the United States economy and to United States public markets, I do expect will begin seeking out smaller companies and undervalued companies. But for now, we're still very much in a passive flow dominated environment of large firm capitalism. So, in a very large picture, the best that I can come up with right now is to stay the course with large growth. I think that the outperformance will continue, at least in the short run. And the ones that I have as underweight are developed markets, and this is particularly EFI, though I do imagine some better opportunities in developed Asia. And emerging markets, I'm not seeing much good in. I don't see a huge problem in emerging markets small cap, as those really haven't been moved either way, but there isn't really any excitement I have for them either. And going back to developed markets for a second, I can certainly see reasons why there may be good increases in European equities, but reasons that would cause them to balloon substantially would also cause great currency risk. And in the short term, any moderate strong increases are just very difficult to imagine being sustainable. So it's not exactly that I'm immediately bearish about European equities, but I'm just very cautious, and I really wouldn't want to linger unless I were very carefully picking individual securities, or I were watching it like a hawk and playing it very tactically. Next are real assets, and I don't see any real problems here. I've generally been very heavy in natural resources and metals, and I think that the larger macro backdrop of recollateralization is a long-term phenomenon. Yet what really stands out are precious metals. And personally, my largest position is silver. I have some writing on that that's going to be attached to my Substack, and I will put an audio version on YouTube. I have a much larger thesis for precious metals laid out there, and for silver in particular. But suffice it to say, I like silver. With debt, the large thing is that it just looks to me like the credit spreads are not giving enough compensation for quite a lot of the debt market. And that's really as simple as it is. The spreads just don't seem reasonable to me. I'm not expecting anything catastrophic at the moment, although my long-term thesis is that at some point, something is going to happen to European debts, and I continue to watch that very carefully. There's also a really unreasonable amount of municipal debt in the United States, and it just looks to me like munis don't have adequate compensation. So really, considering the macro environment, I like treasuries. It seems to me like money is moving toward treasuries, and that seems to be sustainable. The regional breakdown really is in line with what I've talked about so far. I like the United States the best right now, and I just don't feel comfortable with Europe. I think that things are going to get worse in Europe, and at some point, things will break, at least in some countries. Africa's tricky because quite a lot of its industry is European industry, and right now there's just no real use for emerging markets. This really isn't the backdrop for them to grow, particularly as the Eurodollar credit system does not have the juicing power that it once had. Factor in the overall changing credit environment, moves against globalization, and the presence of European businesses. While I think that mines could do quite well, there's just a lot of trouble in Africa that there isn't quite enough upside to justify. Real estate isn't too interesting. Really, I'm mostly fairly neutral, and offices just don't seem like they're coming back, and particularly not Class A. Although I don't have it in the most dire category, as it seems to me that its worst hits are behind it. But I really don't expect much improvement anytime soon. Storage I put as the only overweight because there continue to be good opportunities with good yields, good pricing, and really strong histories. And last, I have different hedge strategies. I don't think that neutral and short are particularly good right now. And this is because it's just really hard to be net short, because the market bias is upward. And in this modern, passive era, short reports just do not have the effect that they used to. Market neutral I also placed at underweight. And that's not because there's anything particularly wrong with it, but there's just really no backdrop that's going to make it perform particularly well. It seems to me like most likely an equity market neutral manager is going to lose out on a lot of return and not really get much out of it right now. I like global macro because in this time of reordering, global macro is the place to be. There are plenty of opportunities for somebody who is able to analyze this absolutely wild environment and act on it. But the one I really placed at the top is managed futures, and this is because of the activity, particularly in metals futures. With just how wild the activity has been in metals futures and the macro reasons why that looks quite likely to continue, I've outlined them much more thoroughly in my writing. And on top of that, heavily backwardated markets. This is the time for a futures trader. So these are the ideas that I have covered in the written version of this report, and I will be putting out the written version tonight and putting out an audio version tomorrow. But just as an overview, I like silver and it's currently my largest position. I have been very heavy in a buy right strategy on some natural resource equities all year. I also like US biopharma and pharmaceuticals, although this is a trickier market. This one I think calls for an active manager, but for somebody who is able to analyze companies quite well. I believe that opportunities absolutely abound. I am quite bearish on European debt, and this has been the case for some time, although I do go into much more detail in the writing. Large media I had originally written as something that I'm bearish on, but I changed it to tactical. And this is because while at the moment I don't feel good at all about large media companies, I suspect that they have some very good assets and some business segments that are capable of doing very well. But it's probably going to be some time before we get into an environment where they are attractively priced and investors are able to buy these assets up for a good return. And last, I thought I'd just share what my largest positions are. I'd like to note that these just include security holdings, and I have excluded any index fund shares I own. So, at number 1, I have silver, followed by gold. At number 3 are the shares of JP Morgan. Then I have Bitcoin, a Treasury Futures Strategy Fund, Sienna, Agnico Eagle, Berkshire Hathaway, Fannie Mae, and Broadcom. I don't see any huge changes, although I have begun selling Berkshire Hathaway and I expect to continue doing so. So that's all for today. I will have the written report out and an audio recording that go into much more depth on my ideas. I will as well be putting out a writing, Narrative and Noise, which talks about all of the noise in the market and all of the narratives which we're constantly bombarded with, and some of the ideas that I've built up on how to deal with them. I as well expect that over the next week, hopefully within a week, I'll be able to get a short film out. I have 2 that I'm working on. One is Occult Finance, which talks about some more mystical and arcane ideas that investors have used, and particularly goes into depth on George Soros. And another is The Superbanks, which talks about the role of institutions like the BIS. Well, I hope there was some use in this, or at least some fun. Have a marvelous evening.